Let's go to Faye. And Faye, what is up for discussion today?
We're taking a closer look at gilt funds and income funds, Nikunjan. When we should choose them, what sort of returns they've been giving off late, especially for those of us who don't want to be taking, that much risk at equity. And there are, you'll find, surprisingly, there are quite a few viewers who want to stay out of it right now. What sort of debt investment should they be using? Let's quickly bring in Dhirendra Kumar. Dhirendra, thank you so much for joining us. Gilt and income funds, which invest in long-term instruments, have climbed to the top of the debt category. 6.75% returns in the last 6 months. What has caused this change of performance? Why are these funds now giving such good returns?
There was a simple, there's a very simple explanation for this. In the last monetary policy, Mr. Raghuram Rajan's statement that he's not cutting the rates, but he's unlikely to hike it, he's unlikely to increase it. And that itself has caused this difference. And long-term gilts reflect all these changes. The change in interest rate outlook gets magnified in long-term gilt funds only because there is no other way investors can actually hold long-term bonds. Only government securities have such long maturity, and long-term gilt funds by their design have very long maturity. And the very possibility, the very likelihood that interest rates will not go up, that itself eliminates the fear from the market that there could of a potential loss, and that translated into this kind of gain. But given that we are still not finding, but at the same time, this may or may not be sustainable. We are unlikely to witness a relentless bull run in the fixed income market or in the long-term bonds, simply because the inflation is not coming down. We have just seen these price hikes in our very basic commodities, and this will actually push up the inflation. And our RBI governor has stated very clearly that he is combating a fight against inflation, and for that he has very limited maneuverability. From that standpoint, I don't see the rates coming down, and nothing prevents him to go back on his word, because he has always given any kind of assurance with the rider that he is fighting inflation and he will do anything to combat that.
But Dhirendra, it's important to remember there's a large difference right now between the best and the worst performers in both the gilt and income fund category. The top fund has given a 6-month gain of 10%. The worst is down 3%. Why is there such a massive difference, and should we be more careful when we choose our funds?
It can be traced back to varying views of the fund manager at the same time, and the kind of portfolio they have carried. If a fund manager carries a 20-year has a portfolio of government bonds, which has a 20 years of residual maturity, which is possible to hold such bonds, then he would have gained substantially, and that is the case. If there's a fund manager who thinks that there is the likelihood of rate cut can't be eliminated, there could be potential losses. If rates go up, then the funds will suffer. A bond can actually go down in value, and he takes a very different view of the rate outlook. He will keep his maturity very low. And both of them have benefited. Long maturity bonds benefit more the moment the outlook turns positive. Positive meaning rates can go down. And so that is primarily the difference, the maturity of the funds held by, because these funds do not have virtually no difference in the credit quality. All kind of gilt funds hold government securities only. The only difference that they can cause in their portfolio, or the way they can manage their portfolio, is the varying maturity of the bonds that they hold. In government security, it is possible to buy very long maturity bonds as well as very short maturity bonds of the same quality.
But Dhirendra, what's your advice right now to investors who are in this category? Do you expect the interest rate cycle to move, and at what point? Which means that should we stay invested then in gilt and long-term income funds?
It is very difficult to guess the interest rate cycle, because that amounts to guessing where the inflation will be, and also understanding what is causing that inflation, whether the government can do something about it, or whether the RBI and I don't think it is wise to be guessing the RBI's actions. And so from my standpoint, I would be guided by an investor's need. If there is an investor who is a long-term investor and he's willing to take chances of an intermittent decline in value, he can consider it. Otherwise, for most investors, they will do well to keep away from long-term gilt funds, because there is a scale of, there is a great degree of unpredictability cannot be ruled out. There are other funds which can serve your needs well. Money for few days, be into liquid fund. Money for up to a year, and you don't want to take any substantial chances, you have short-term bond fund. You have a frozen time frame for your investment and you don't want to take any chances, you are getting very attractive return on fixed maturity plans. So that is the other way to go. So opportunistic investor, they should consider a dynamic bond fund or an income fund which tries to capitalize on such opportunity at the same time. They may be a little less volatile, and funds with little credible history. But I would say that if you are looking for a risk-free return, your appetite for downside is virtually zero. If you can't stomach that kind of decline in value, then follow all other principles. Keep away from gilt funds.